Well, hello guys, and glad to have you on board again today. I kind of feel like I have to open kind of an appendix number 1 on the yearly review because this is something that I wish I didn't forget, but turns out I did. And this is kind of a major piece, and I think it's worth pointing out today. So kind of, yeah, adding another video to this very long and existing series of 2023, because this is definitely a complicated year to navigate. But I've decided to call that one an appendix because that's not necessarily something that will have immediate actions on the way you will manage your portfolios in 2023, or at least the way I will manage my own. Though the thing is, still, I should have mentioned this thing in the global macro forecast and the different models, which turns out I did not. So in that perspective, this is something that was worth pointing out. And here we are. This is the model that we should have been talking about. The thing is that for those who were long-term listeners of this channel, you probably have seen that one already. Just to show you the math behind it, which is real simple. This is just using 3-month yields subtracted by the 2-year, which is basically the difference between 3-month and 2-year yields, divided by the 10-year yield. So this is basically kind of a composite short-term end of the stick of the curve divided by the longer end. So this is kind of a very weird but still very efficient kind of representation of the yield curve in a graphical form, which gives us kind of an oscillator view. Though this thing, as it is just yield divided by yield, just can't go to infinity and so on. It will normally and organically oscillate like that. So what we've noticed back then is that the oscillation tend to exacerbate itself over time, so probably due to the heavy impact of monetary policy on the latest 30 or 40 years. And basically that's one thing. That means what we're measuring in here is the impact of the yield curve reversion on lower end curves down to longer end curves. So basically, you know, the Fed has more control over the short-term end of the stick. So basically, this is highly correlated to the Fed funds rate, where this one less likelier and this one far less likelier as well. So this is really the one it is. These two folks move with a slower pace, kind of a delay, when this one is very closely related to Fed funds rate. So this is the first reason that explains why this thing is in a kind of an expanding wedge structure. Anyway, those two lines in here are kind of representation of the 95th percentile, which is basically anything that occurs less than 5% of time. So this is basically, we trade less than 5% of time across these two lines. Of course, they have to have symmetries, which means this is our center of gravity. This is kind of where there is equal presentation on the upper half of the chart and the lower end. So basically what that thing tells us is that if we put it into context, assessing that this can only be an oscillator due to its mathematical formula, then in that perspective, what we have in here is just no more than the representation over time of yield curve control. This is basically the thing that we will do, although this is on the American kind of yield curve, which is basically we look at the Fed's actions on the market. And what's staggering is that by looking at it, we can definitely see that, of course, some of it is on the Fed's control, possibly the lower end. The longer end is out of any Fed's control, which is basically this is economic cycle. So we have two components factor into that equation. And the simple way to understand it is that most of the time, things are balanced, which means we're in these areas, and sometimes we get across the 95th percentile, which means the less than 5% occurrence events in both ends of the stick. Basically, we've got extreme bottoming events on that chart and extreme topping events. So what matters is to clarify what these two mean. Though in that perspective, the lower end 5 percentile, which is in here, in here, in here, in here, and in here, okay, and we've got few replications in here and in here, give us kind of a pattern, okay? So what we can see is that generally we tend to go from the top end first with a couple of touches in here, very quick ones. There seems to be 2 touches, bam, bam, and then we go lower. Same thing goes in here, 2 touches, and then we immediately go to the opposite direction. All right, that's very significant. We had the same old thing in here, 2 touches, an immediate showdown in here. And what we can see is that this is a pattern that tends to replicate. The second touch makes an immediate low, and then we go right back to the neutral area, and then we make a second low, generally rebouncing afterwards in the opposite direction, and the pattern replicates itself. Okay, so it's one way straight down, 2 ways up. Okay, so then as you can see, we do 2 touches to the upside. Okay, so this is basically up. We go back to neutrality, then we go back up, and we go straight line down. Okay, so straight line down, 2 ways up, back to neutrality, second leg up, all the way down. Okay, so that's really, really, really staggering. We've got the rebounds. Okay, second leg down, and now the leg up. Okay, so that's really, really fancy to me. So the thing is that we're on the verge to go to this same old extreme level that will precede the forthcoming recession. So what mattered to me when I was looking at that thing is that I use it as a risk measurement factor of the bond market. And you know, the bond market is the hardest market to manipulate, even though the Fed has tried by manipulating the lower end of the curve, still hardly can manage the 10-year yield to do anything but following the economic cycle. So in that perspective, what's staggering to me is that I've always mentioned that we're currently on that stage, meaning that we're still getting ahead of the next crisis, but God knows how long it will take, because we can clearly see that the duration kind of started to expand. So this is just, of course, 2 occurrences. So this is nothing close to be a pattern. But I've started to say, well, I don't see the next crisis occurring before 2030 or something like that. This is kind of a decade, generational stuff, 2000, 2010, 2020, and so on. So that was my early assumption. But as usual, these are just no more than models. It also tends to correlate with the Armstrong cycle, which says the big crisis should be headed into creating a peak around 2031, and meaning that the corrective cycle, which is likely going to be accompanied by the crisis, should be around that timescale. So I wasn't particularly concerned about an immediate kind of event like that, which will cause prices to go down. So this is basically measuring deflationary risks. Though in that perspective, I was like, yeah, I don't know. But this is starting to raise some concern to me, because I wish I could have mentioned this in the yearly briefing, because it had to be. The thing is, well, if this thing turns to red flag earlier than expected, meaning that the Fed clearly has over-tightened in 2022, we've mentioned that in the brief, that doesn't mean the market will not come close with it and kind of spend some time in here, which we generally tend to do, oscillate across these median values, preparing, of course, for the next crisis to show up, and which will have to show up with 2 touches in here before we go straight line down. Okay, which in my personal opinion should be around 2030. So my current modeling was like, okay, we're probably going to spend some time there, multiple years, which is basically anything correlated to stagflation environment, which is basically on one end the Fed is trying to control, but on the other hand the 10-year yield is under pressure because of inflation. Though in that perspective, we were expecting some kind of a balance in here. Though the thing is that this is kind of, yeah, could be acceptable, but we really want to go back down to some more neutral level, because if we cross above the 95th percentile, though in that perspective, I would start to say, well, maybe we're off my chart, which is few years of stagflation before, of course, we go back to more inflation, kind of a second spike, and of course, and then the end, the deflationary crisis. Because it's going to happen sooner or later. There's definitely a credit bubble, just no one knows where this one's going to pop. We've kicked the can down the road multiple times in the past, and we're probably going to try doing it again. But the thing is that, yes, inevitably, at some point in time, this thing will blow off. But that doesn't mean it will happen tomorrow. So I've always said I have a few models. These models are nothing perfect. Armstrong is one of these, and they all tend to somehow rhyme with 2030. Reason why? Well, as long as I have no red flag, I will go along with that timescale. So this could be a red flag. That's the reason why I want to kind of record that appendix number 1 today, to say, well, I'm going to have to monitor this thing through 2023. So hear that one very well. That doesn't mean there's an immediate threat, an immediate risk, because from what we've seen, there has to be 2 spikes up to call the red flag immediate risks for the market. So we're definitely not yet there, and nothing close to this. So this isn't going to happen in 2023. Make it real clear. Probably not even 2024. But the thing is, well, we need to look at it through 2023 on a monthly basis or quarterly basis, because if things don't reverse course and go into this 95th percentile, and in that perspective, that will just send me one message, that we will know with a definite confidence level that the corrective cycle, which the actual Armstrong model as well forecasts to be happening in 2024 down to 2028, or mid-2024 down to 2028. In my humble opinion, for now, we're supposed to be a stagflationary cycle, meaning that even if there will be corrective economic cycle, meaning probably recession type stuff, there will likely be sustained level of inflation forcing the prices to maintain average level. Basically, the market will be flat, neutral, volatile still, but flat, neutral, net-net, because of inflation and economic recession fighting each other through prices. Though, in my assumption, that has likelier chances to pull that thing back to neutrality in kind of a noisy stuff for a few years before, of course, starting 27-28, we start to flash the first red signal ahead of a second one in approximately 2029 or 2030, headed into the next big crisis, which should occur around 2030. So that was my model so far. So like I said, not rising any flags for now, just saying there's still 40 days to come before these candle close. And if it does close like that, and if the next month is in the lines keeps heading higher and higher because for whatever reason the Fed doesn't nearly stop rate hiking or stuff like that, then we will have a problem. Because for now, to put it simple, most of these actual relative measurement in here doesn't necessarily come from the Fed. I think the current misalignment with my model comes actually from the 10-year yield. If I look at this one, well, in a much short-term vision, we can clearly see that when the lower end curve of the stick is controlled by the federal funds rate, which has just been consistently being raised because of the Fed rate hike. But the thing is that from what we've seen, started in November, where the Fed probably shouldn't have gone 75 basis points, the 10-year yield kind of got into an opposite direction, though widening the spread between these two. Though the thing is that we now know the Fed is going to slow down the pace of interest rate, now is an appropriate time for the 10-year yield to start catching up with these, which would, as you got it, 10-year yield is the denominator in this function that we were looking at. So if the denominator rises, of course, the output of that fraction is going to go down. So what I intend now is the 10-year yield to catch up with the lower end curve of the stick, which would go back to my model kind of forecast. If it doesn't, and if for whatever reason the 10-year yield keeps heading down when this one keeps being put into pressure because of the Fed, then in that perspective, we're going to have a problem. The message will be, if we tend to reach out the 95th percentile and above, that will be the sign that I'm probably wrong with my longer-term forecast and that the big deflationary crisis will show up earlier than expected. Basically, we could have a pop in early 2025 or possibly late 2024. This is kind of the late stage of the modeling system that we use in those yearly forecasts. Remember what I said, when I make my 2023 forecast, it certainly doesn't start by the 31st of December. That would be as stupid as crazy fuck. Now the thing is, in here, it can of course last to 2024. Though today's lesson on this appendix number 1 is that we need to monitor carefully these things. For now, I clearly don't see any red flag, but could be. So, need to review this each and every time there is an FOMC meeting ahead of now. I will definitely have a look at this thing to see where it goes. If it goes against my will or if it goes into the expected direction. As long as it goes to the expected direction, well, nothing to worry about. I'm not changing anything to my forecasts. I still forecast years of stagflation, more or less violent, of course, depending on the economic conditions, and the violent recession that is anyway headed to us. But a recession with inflation is certainly not bearish for prices, like I've always said, and the yield curve will be under pressure, but more into neutrality. Second stage is, of course, if this thing tends to cross the 95th percentile, that triggers the fact that the significance of the risks for actual deflation, okay, so this is the kind of recession that is coupled by deflation, in which prices severely go down as the economy contracts. If and only if we show up above the 95th percentile, that's a sign that there is a likelier probability for this thing to happen earlier than expected, and that means I will eventually gonna have to take that into my assumption for the 2024 forecast. So the message is, it's nothing to worry about now, neither in 2024 or early 2024, which is the timescale we use in this 2023 forecast. But all across 2023, we rather like to look at that model over time to make sure it either invalidates or changes the behavior, or validates or changes the behavior for the years ahead. So this is kind of just like something that needs to be monitored, not necessarily actively traded. Okay, so bear that one in mind, but I thought it was worth pointing out as something that was definitely missing in the 2023 review, because I should have talked about it and I just forgot about it. So now you have a complete vision of it, nothing to worry about, just something to carefully look at. That being said, more than enough for today. Bye-bye.